The friends who are familiar with me know that I've been keeping a close eye on Alibaba. They've been through some tough times in the past few years, but they've also made some big changes in recent days. Even the boss man, Jack Ma, said they needed to shake things up. So, what's Alibaba been up to since 2024? And how are these changes gonna affect their business growth and the juicy stock price? Is Alibaba still a good investment in the years to come? So, all the things you want to know will be covered in my video today. Don't miss it. I'm Sheila Wang. I'm here to update the most cutting-edge and fresh business and investment information. So don't forget to smash that like button and subscribe my channel. I also welcome you to join the discussion in the comments section below. And if you are interested in a more in-depth investing report, make sure to check out my analysis report down below. Now, let's dive into today's topic together. To run faster, you're gonna ditch the excess baggage. Alibaba's been feasting on the internet boom for decades, and as they grow, they piled all sorts of departments and stuff. It's like they were always adding more and more things on themselves. But now, Alibaba finally realized it's time to cut the fat. So what exactly are they cutting back on? Well, I've gathered some info for you. Firstly, let's talk about Hema Fresh, which was highly anticipated to be independently listed in the past year. It used to be Alibaba's new retail benchmark, but due to the persistent profitability challenges and the other difficulties, its plan for financing and listing have been put on hold. Now, there are rumors circulating that Alibaba has internally decided to sell Darunfa, which is the domestic market, with Darunfa, the supermarket, estimated at around 10 billion RMB and Hema at around 20 billion RMB. However, the relevant officials have confirmed that these rumors are fake. Nonetheless, it cannot be denied that Hema's recent actions, such as the salary cuts and outsourcing of employees, have fueled the speculation of potential sale. Combined with Alibaba's repeated message of focusing on its core business and various other factors, it has intensified the speculation from the outside world. From my point of view, my friend, compared to Hema, In-Time Department Store and Sonic Retail are both companies acquired by Alibaba. These serve as a supplementary asset in the new retail sector, but their business models are more traditional, making them more like candidates for sale. After all, Hema is Alibaba's benchmark enterprise that was personally incubated by the company, and with over 8 years of substantial investment, unless the price is right, the likelihood of a fire sale is relatively low. So you got me. I don't think that Hema is for selling right now. My speculation has been somewhat validated. Alibaba did indeed start by shutting down some of its more peripheral businesses. This March 15th, there was media reports that Alibaba is preparing to shut down Retail Tone. From the messages circulating in various retail terminations and Retail Tone groups, it's clear that the news has been confirmed, and the shutdown of Retail Tone will be effective from March 30th. So maybe you wonder about what is Retail Tone? Well, it's a network of retail stores. Back then, Alibaba's slogan was to use new retail to transform 6 million small family-run stores. Retail Tone had already covered 1.5 million small stores in 21 provinces and cities, accounting for a quarter of the country's official retail stores. It became the #1 fast-moving consumer goods B2B platform in China. Now that Retail Tone is being shut down, it shows that Alibaba's determination to lighten its load. some former employees of Retail who had already resigned believed that Retail's business itself could continue to grow, and its closure should be a decision made by the top management. It was not running at a loss, so it's a pity to see it go. Therefore, we dare to speculate that as Alibaba's strategy continues to contract, there will be further reductions in non-core businesses. In February this year, during Alibaba's second quarter fiscal year 2024 earnings conference call, Alibaba Group's chairman made it clear that there's still a significant number of traditional offline retail businesses on the company's balance sheet. However, these are not company's core businesses, and it's reasonable for Alibaba to cut them down. But considering the current market situation, it may take time to realize this access. As for Hema, this offline retail format has not been defined as core business already and may be also be cut down. There are reports that Hema is currently actively seeking new strategic investors and has been in contract with several potential investors. So, where will Hema go next? It has reached a crossroads. Of course, Alibaba is making adjustments to their core corporations and dealing with the impact on their stock price. You see, their stock price has taken a nosedive. So, is it a good time to jump in? I will answer all these questions in my paid report this time around, folks. But for now, let's dig into what burdens Alibaba need to shed in order to get back in the race. Alibaba's subtractions also lies in the stock purchases related to hot trends. According to filings with U.S. Securities and Exchange Commission, Alibaba sold a total of 33 million American depository shares ADS of Xiaopeng model through Taobao China, with total value of approximately 2.2 billion yuan, which is nearly $315 million, at a transaction price ranging from $9.6 to $9.7 per share, which is lower than the market price. It's worth noting that this is not the first time Alibaba has reduced its holdings. In December 2023, Alibaba sold 25 million ADS of Xiaopeng models for a total of approximately $391 million. Currently, Taobao China holds 192 million shares of Xiaopeng models, accounting for 11% and making it the second largest shareholder of the company. Even after the reduction, Alibaba remains the second largest shareholder of Xiaopeng. Regarding the reduction, a spokesman from Alibaba Group stated, "We sold a portion of our Xiaopeng shares based on our capital management goals, reducing our stake from 10% to 7.5%. Industry analysts have speculated that Alibaba's reduction of the Xiaopeng model's share reflects a pessimistic outlook on the future development of Xiaopeng, and the company's financial performance has also been less than ideal. Additionally, Alibaba will sell 30.85 million American depository receipts of Bilibili, with an expected pricing of $11.6 per ADR, raising approximately $357.8 million. In response to this, Alibaba stated that the sale is primarily based on its own capital management goals and will not affect the cooperation between the two companies. Alibaba's related business will continue to strengthen their collaboration with Bilibili in various areas. As of the close of March 22nd, Bilibili stock in the US stock market dropped by over 8%. Furthermore, Alibaba has previously reduced its holdings of Wang. It is evident that whether it's Bilibili, Xiaopeng model, or Wang, these companies have all failed to achieve profitability. As we all know, the essence of business lies in purchasing profits, and investors seek to ensure their own interests are maximally protected. Alibaba is not a philanthropist, and the decision to reduce its holdings in these companies that have long-term investment but are struggling to generate corresponding returns is clearly based on sound business logic. All these moves undoubtedly indicate that Alibaba is focusing on its core business and downplaying its investment aspect. Apart from the issue within these companies themselves, Alibaba's internal strategy adjustments and resource allocation optimization are also important factors. Turning the situation around is not an overnight success. Though Alibaba's latest financial report released in February this year showed double-digit growth in revenue and net profit for the full year of 2023, actual impact is not significant. Take the fourth quarter of 2023 as example. During that quarter, Alibaba achieved a revenue of 260.35 billion yuan, a 5% year-on-year growth, but its net profit was only 10.7 billion yuan, a 77% year-on-year decline. This indicates that despite Alibaba taking action and strategic adjustment, more effort and time are still required to truly overcome the challenges. So that's all for today, my friend. I hope that's useful as usual. See you next time.